Imagine a company announcing record profits, attracting investors, raising bank finance, boosting stock prices, and projecting extraordinary growth. But later, regulators discover that the financial statements never reflected the true financial position of the company. Assets were overstated, liabilities hidden, losses manipulated, and disclosures selectively presented. Overnight, investor confidence collapses. Directors face liability exposure, auditors come under scrutiny, and the company enters governance crisis. In modern corporate law, one provision stands at the center of financial truth: investor trust and governance credibility. Section 129 of the Companies Act 2013, dealing with financial statements. Welcome to Corporate and Securities Law Compass, navigating law with clarity. Today we are discussing one of the most powerful and foundational provisions under the Companies Act 2013, Section 129 relating to financial statements. This provision is not merely an accounting rule. It is not merely about balance sheets and profit statements. It is the legal architecture through which a company reveals its financial reality to shareholders, creditors, regulators, investors, and the public. Every investment decision depends upon it. Every audit revolves around it. Every board meeting relies upon it. Every lender studies it. Every regulator examines it. And every corporate fraud investigation eventually reaches it. Section 129 therefore represents the heart of financial governance in corporate law. To understand this provision properly, we must first understand why financial statements are so important in modern corporate governance. A company may make promises, a company may advertise growth, management may speak confidently, stock prices may rise, but legally and commercially, financial statements remain the most important structured representation of corporate financial truth. Investors trust them, banks rely on them, creditors evaluate them, regulators monitor them. If financial statements become unreliable, the entire capital market ecosystem becomes unstable. This is why Section 129 imposes strict legal obligations. Historically, many of the biggest corporate scandals globally emerged from manipulated financial statements. Hidden liabilities, artificial profits, inflated revenues, undisclosed debts, fake transactions, off balance sheet arrangements. These failures destroyed investor wealth and market confidence. The Companies Act 2013 therefore strengthened governance expectations significantly compared to earlier frameworks. Section 129 reflects this evolution toward transparency, accountability, and financial integrity. Now let us understand the statutory framework carefully. Section 129 provides that financial statements shall give a true and fair view of the state of affairs of the company, comply with accounting standards notified under Section 133, and be in the form provided for different classes of companies in Schedule 3. Immediately, several foundational concepts arise: financial statements, true and fair view, accounting standards, Schedule 3 compliance, consolidated financial statements, board approval, shareholder accountability. These concepts together form the core of financial governance. Now let us understand the expression financial statements. Under the Companies Act, this includes balance sheet, profit and loss account, cash flow statement, statement of changes in equity wherever applicable, and explanatory notes attached thereto. For certain classes of companies, exemptions may exist regarding cash flow statements. But generally, financial statements represent a complete financial picture of the company. Now let us discuss the phrase true and fair view. This is one of the most important legal concepts in accounting and corporate governance. The law does not merely require mathematical accuracy. The statements must fairly reflect economic reality. A technically correct but misleading presentation may still violate governance expectations. This principle gives enormous importance to disclosure quality and transparency. Now let us discuss accounting standards under Section 133. Financial statements cannot be prepared casually according to management preference. They must comply with notified accounting standards. This ensures consistency, comparability, and reliability across companies. Now let us discuss Schedule 3, because this is extremely important in practice. Schedule 3 prescribes presentation formats and disclosure structures, classification of assets, liabilities, equity disclosures, related party transactions, contingent liabilities. All these become regulated through Schedule 3 requirements. This creates standardized corporate financial reporting. Now let us discuss consolidated financial statements, because this area carries enormous practical significance. Where a company has subsidiaries, associates, or joint ventures, consolidated financial statements become relevant. This prevents manipulation through group structuring. Without consolidation, companies could hide liabilities or losses inside subsidiaries. Thus, Section 129 promotes group-level transparency. Now think practically. Suppose a holding company appears profitable individually while major liabilities remain hidden in subsidiaries. Without consolidated reporting, investors would receive distorted information. This is precisely why consolidation requirements matter. Now let us discuss the legislative intent deeply. The law seeks to ensure that stakeholders see the real financial position of the corporate group rather than selective financial narratives. This strengthens investor protection enormously. Now let us discuss board meeting procedures. Financial statements must be approved by the board before signing and circulation. This is critically important. The board cannot blindly rely on management representations. Directors carry governance responsibility. Audit committees, CFOs, statutory auditors, and compliance teams interact heavily during this process. Now let us discuss signing requirements. Financial statements are generally signed by authorized directors, CEO, CFO, or company secretary, depending on applicability. These signatures carry legal significance. They represent accountability. False certifications may create severe liability exposure. Now let us discuss AGM relevance. Financial statements are placed before shareholders in annual general meeting. This creates shareholder oversight opportunity. Shareholders examine profitability, liabilities, governance quality, and future risks through these documents. Thus, Section 129 directly supports shareholder democracy. Now let us discuss the connection with Section 134. Section 129 governs financial statements themselves. Section 134 governs board's report attached thereto. Together, they create the complete corporate disclosure framework. Now let us discuss the role of auditors. Auditors examine whether financial statements provide true and fair view and comply with accounting standards. This creates a governance ecosystem where management prepares, auditors examine, and shareholders review. Weakness at any level can create governance collapse. Now let us discuss practical governance risks. Revenue inflation, improper related party disclosures, undisclosed contingent liabilities, improper asset valuation, manipulated impairment calculations, incorrect consolidation, off-balance sheet exposures, weak disclosure practices. These are major governance risk areas under Section 129. Now let us discuss a practical case study style illustration. Imagine a listed company aggressively recognizing future revenues as current income to show extraordinary profits before a public fundraising exercise. Stock prices rise. Investors invest heavily. Later, auditors identify accounting irregularities. Restated financial statements reveal major losses. Investor wealth collapses. Directors face scrutiny. Regulators investigate. This demonstrates why Section 129 is central to market integrity. Now let us discuss another practical scenario involving subsidiaries. Suppose a parent company transfers debt-heavy transactions to subsidiaries to improve standalone appearance. Consolidated financial statements expose the true group position. Without Section 129 consolidation principles, investors might be misled completely. Now let us discuss applicability across company categories. Private companies remain fully governed by Section 129. Public companies face broader stakeholder scrutiny. Listed companies face the highest disclosure expectations. OPCs may receive certain relaxations regarding cash flow statements. Small companies and dormant companies may enjoy limited procedural relaxations in specific contexts. But financial integrity remains universally essential. Now let us discuss ROC filing implications. Financial statements must generally be filed through Form AOC4 and related forms. This is one of the most important recurring ROC compliances. Incorrect filing creates significant exposure. Now let us discuss common ROC rejection reasons. Mismatch between board report and financial statements. Incorrect XBRL filing. Defective attachments. Improper auditor details. Unsigned documents. Mismatch in dates. Incorrect consolidation disclosures. These operational mistakes frequently occur in practice. Now let us discuss XBRL, because modern compliance increasingly depends upon structured electronic reporting. Listed companies and specified entities may require XBRL filings. This improves regulatory analytics and data transparency. Now let us discuss the role of company secretaries. Company secretaries coordinate board approvals, AGM circulation, filing timelines, audit coordination, and compliance documentation. They often become central governance coordinators during financial reporting season. Now let us discuss the role of chartered accountants. This provision is deeply connected with audit and accounting practice. Verification of accounting standards, disclosure compliance, true and fair presentation, consolidation, internal controls. All these become central professional responsibilities. Now let us discuss cost accountants. In manufacturing and regulated industries, cost records and internal cost systems may influence financial reporting quality significantly. Now let us discuss advocates and litigation perspectives. Misleading financial statements often trigger shareholder litigation, SEBI proceedings, fraud allegations, class action claims, and insolvency disputes. Legal interpretation of disclosures becomes critically important. Now let us discuss hidden exam traps. Students often confuse books of account under Section 128 with financial statements under Section 129. Books are raw accounting records. Financial statements are structured summaries derived from those books. Another common mistake is ignoring consolidated financial statements. This area carries major practical importance. Now let us discuss secretarial audit perspectives. Secretarial auditors examine governance processes surrounding approval, signing, circulation, and filing of financial statements. Repeated non-compliance indicates governance weakness. Now let us discuss due diligence perspectives. During mergers, acquisitions, IPOs, and investments, financial statements become primary due diligence material. Weak disclosures create valuation risks. Investors heavily rely upon Section 129 compliance quality. Now let us discuss connection with SEBI regulations. Listed companies face extensive disclosure obligations under SEBI LODR. Quarterly results, material event disclosures, related party transaction disclosures, audit committee governance, all connect deeply with Section 129 principles. Now let us discuss FEMA and RBI relevance. Foreign investment reporting, overseas subsidiaries, external borrowings, and cross-border transactions affect financial reporting complexity. Improper disclosures may create multi-regulatory exposure. Now let us discuss income tax implications. Tax authorities frequently examine financial statements during assessments. Mismatch between tax reporting and financial disclosures creates scrutiny risk. Thus, Section 129 intersects taxation governance strongly. Now let us discuss technological transformation. ERP systems, AI-based accounting tools, cloud reporting platforms, and automated consolidation systems transformed financial governance significantly. But technology cannot replace ethical governance. Fraudulent intent can manipulate even sophisticated systems. Thus, director oversight remains essential. Now let us discuss practical drafting precautions. Ensure accounting standard compliance rigorously. Review related party disclosures carefully. Validate contingent liabilities honestly. Monitor consolidation accuracy. Maintain strong internal controls. Coordinate closely with auditors. Preserve audit trail documentation. Review board minutes thoroughly before approval. These precautions significantly strengthen governance reliability. Now let us discuss one of the deepest governance insights connected with Section 129. Financial statements are not merely compliance documents. They are instruments of trust. A shareholder may never visit the company factory. A lender may never meet operational staff. An investor may never inspect inventory personally, but all of them rely upon financial statements. That trust sustains capital markets, and Section 129 protects that trust legally. Now let us discuss investor psychology. When investors believe disclosures are transparent, capital flows increase. When financial reporting credibility collapses, markets react brutally. Thus, financial governance directly affects economic stability. Now let us discuss judicial principles. Courts and tribunals increasingly examine whether disclosures reflected substance over form. Technical compliance alone may not always protect management if financial presentation misleads stakeholders materially. Now let us discuss governance philosophy finally. Corporate governance ultimately depends on truthful disclosure. Without accurate financial statements, there can be no informed shareholder voting, no reliable lending, no fair market pricing, and no effective regulation. Section 129 therefore stands at the center of corporate transparency architecture. For directors, it creates fiduciary accountability. For auditors, it defines professional responsibility. For company secretaries, it represents major compliance coordination. For investors, it creates decision-making confidence. For regulators, it supports market discipline. For litigators, it becomes evidentiary foundation. For students of corporate law, it demonstrates how financial truth becomes legal obligation. And for modern corporate India, Section 129 remains one of the strongest safeguards, ensuring that companies cannot merely create financial narratives. They must present genuine, transparent, and legally compliant financial statements capable of revealing the true economic reality of the enterprise to every stakeholder relying upon them. If you like this video, kindly like, subscribe, and hit the bell icon for latest notifications from Corporate and Securities Law Compass. Like, share, comment, subscribe.